Floods, heat waves, droughts, gender inequality, rising poverty, loss of biodiversity. Humanity is facing unprecedented social and environmental challenges. But we can still turn the tide. Financial services play a crucial role in making the global economy more sustainable. As a leading financial centre, Luxembourg helps steer investments into sustainable solutions. By connecting capital with responsible companies and projects, Luxembourg makes a significant contribution to the next generation. Invest in the future. Invest in sustainable finance.
Welcome to the Sustainable Finance Forum, bringing together key sustainable finance experts from across the world to share their views on how finance can shape a sustainable future.
Ladies and gentlemen, good morning, good afternoon, good evening. Wherever you are in the world, a warm welcome to this 8th edition of the Sustainable Finance Forum, coming to you from our studio in the European Broadcasting Centre in the heart of Luxembourg. My name is Judith Bogner. Once again, I'm truly honoured and delighted to lead you through this digital event on behalf of Luxembourg for Finance. First up, we would like to express our gratitude to our sponsors and our media partner, the Financial Times. We also thank our expert speakers who set aside time to join us and share their insights with us. And we thank all of you who are joining us from around the world, from 62 countries. Truly the most diverse community since we kicked off this event 8 years ago. This, of course, will be recorded. The recording will be made available to you after the event is over. And also a caveat, if you could do us a favor, and if you happen to post something on social media, please add the handle @LuxFinance for Luxembourg for Finance so we can see your comments. I think we can all agree that sustainable finance at this point has become an integral pillar of global financial markets, despite the polycrisis of recent years. And I would even go as far as suggesting that sustainable finance has reached a crossroads where it creates understandable friction, because engaging with sustainability means drawing ever more attention to material risks related to climate, to nature, to our societies, that could threaten or at the very least undermine long-term economic and financial thriving and stability. And a case in point is the latest report by the World Meteorological Organization, which underpins prior analysis by NASA and also the EU's Copernicus Earth observation team. And the report says the last 10 years were the warmest on record, the very warmest being 2024 with 1.55 degrees above pre-industrial levels. And the report goes on to say that there's an 80% chance that between now and 2029, so the next 4 years out into the future, at least 1 year could even be warmer. And every additional fraction of a degree of warming drives more harmful heat waves, extreme rainfall, and droughts, and melting of sheets, sea ice, glaciers, heating of the ocean, and rising sea levels. And as if on cue, we recently saw the unprecedented collapse of a glacier in the Swiss Alps in the middle of Europe. And this is why Günther Thalling, a board member of one of the largest insurers worldwide, Allianz no less, wrote in March that climate risk is not a distant threat. He wrote, and I quote, "We are fast approaching temperature levels where insurers will no longer be able to offer coverage for many of these risks. This is already happening. Entire regions are becoming uninsurable. This is not a one-off market adjustment," he says. "This is a systemic risk that threatens the very foundation of the financial sector. If insurance is no longer available, other financial services become unavailable too." And so as these considerations have become more deeply embedded. The focus of investors has been shifting from merely reducing emissions in their portfolios to seeking diversification and real economy impact. And this is why today we'll speak a lot about the potential and the importance of transition finance, of sustainability-linked bonds, as well as investing in a sustainable ocean economy through the innovation of blue finance. I will also address the evolution of labels and ratings and the EU's sustainable finance regulatory architecture. As you may be aware, the EU Commission has put forward the so-called Omnibus package, which aims to streamline and simplify this architecture in order to strengthen competitiveness. Now, while these efforts have been welcome, there's also somewhat concern about undermining potentially legal certainty and the provision of clear and transparent data, just when both are so much needed to scale up sustainable investment. And of course, over in the US, we've seen the shift in rhetoric on ESG and climate-related finance, which has resulted in significant outflows from ESG funds, as you will see in our report, a reality check on ESG. And yet, what you will also see is that there is a long-term underlying trend that is indeed strengthening. But first, it's my distinct pleasure and honor to introduce you to our keynote speaker for today. She's a Spanish economist and lawyer with a 30 career of service in public policy, economics and finance. Last year, in January, she followed in the footsteps of Werner Hoyer at the helm of the European Investment Bank. Prior to that, between June 2018 and the end of 2023, she served as Vice President of the Government of Spain, as Minister for Economy, Trade and Business, and also as Minister for Economy and Digitalization. Additionally, in 2022 and 2023, she chaired the International Monetary and Financial Committee of the IMF. And before joining the Spanish government, she had a 12-year tenure at the European Commission, where she was Deputy Director General for Competition, Deputy Director General for Financial Services, and Director General responsible for the EU budget. In her earlier career in Spain, she had different roles at the Ministry of Economy, focusing on areas such as macroeconomic forecasting and analysis, foreign trade, and economic policy before becoming Director General for Competition in 2004. Now, her leadership has been recognized by a number of prestigious awards, including the US Foreign Policy Association Medal, the Women in Technology Award, and also the Master of Digital Award, all of which showcase her contributions in areas such as tech development and international cooperation. So, ladies and gentlemen, please join me in offering a warm welcome to Nadia Calviño, President of the European Investment Bank.
Dear friends, it is a great pleasure to share some thoughts about sustainable investment in a rapidly shifting global landscape, where words like climate, gender, and sustainability are becoming revolutionary. At the European Investment Bank Group, we see these ideas as common sense, a no-brainer for policymakers, investors, and businesses alike. And I know we share a common vision with Luxembourg for Finance. Luxembourg has emerged as global center for green finance and committed partner in our work with pioneering joint initiatives such as the Climate Finance Platform. Let me share 3 reasons behind our conviction that we are on the right path. First, our past experience. The EIB Group already dedicates over half of our annual financing to climate and environmental sustainability. We plan to reaffirm this commitment later this year with the next phase of our Climate Bank roadmap. The result? We have consistently seen strong rewards in pioneering sustainable financing solutions. And this clearly shows that what is the right thing to do for the planet is also the smart thing to do for our business and for our shareholders. Green bonds, which we were the first to introduce onto global capital markets in partnership with the Luxembourg Stock Exchange, is now a multi-trillion asset class in its own right. In total, the EIB has issued more than 120 billion euros in sustainable bonds, with robust market demand and stellar AAA credit rating. And we're going from strength to strength. The inaugural climate awareness bond, aligned with the European Green Bond Standard that we issued in April, was oversubscribed more than 13 times. And recently, we extended the scope of our sustainable awareness bonds to women's entrepreneurship and gender equality, beyond eligibility such as water, education, health, and housing. In these very volatile times, these securities are also building blocks towards a European Capital Markets Union. They are creating a European safe asset for investors, an increasingly deep and liquid market under a European flag. Market demand is boosting the appeal of the euro and Europe as a safe harbor. Coming now to the present, we are currently witnessing across the world an energy and technology revolution in full swing. Clean energy investment is rising to successive record highs every year and now exceeds 2 trillion euros annually. Any good investor will seize the opportunities from this unfolding transition. Initiatives such as the Luxembourg Green Exchange are instrumental in presenting investors with a full palette of sustainability-oriented products to allow them to seize these opportunities. Which brings me to the last point, the future. According to the International Energy Agency, a third of the cuts in global emissions will come from technologies that are not yet available on the market. And that is a real business opportunity for European companies to make climate and competitiveness a winning tandem. At the EIB Group, we are launching new financing products to reinforce this link between sustainability, innovation, and economic growth. Under the umbrella of the New Tech EU program, the biggest ever financing instrument to invest in new technologies, we will roll out tailored financing instruments such as counter-guarantees to support European grid manufacturers, renewable energy producers, and help reduce energy prices for businesses. We will also invest in breakthrough clean tech, such as carbon capture and storage, new innovative batteries, and critical raw material processing. Dear friends, any investment is a stake in tomorrow's world, and it is in our hand to determine how it will be. The EIB Group's priorities reflect Europe's priorities, and they also reflect Europe's values as a beacon of human rights, rule of law, stability, and shared prosperity. Sustainable finance is about investing with purpose, investing in the world we aspire to build for ourselves and for our children. It's about building bridges to a better future. And this is why we intend to stay the course, with you as fellow travelers sharing the road. Thank you.
Thank you. Nadia Calviño there, President of the European Investment Bank. And now I have the pleasure to welcome back to the Sustainable Finance Forum Luxembourg's very own Minister of Finance, His Excellency Minister Roth. Warm welcome, Minister. Good to have you back with us, and you have the floor.
Ladies and gentlemen, building tomorrow today, the most important building blocks for this are sustainability and sustainable finance. Across our continent, the case for sustainable finance has never been stronger, no more urgent, because Europe today stands at a historic crossroads, a time of geopolitical instability, a time of economic realignment, a time of great technological promise, yet persistent societal unease. But in this moment of complexity, one fact is clear: finance is part of the solution. It can fund our climate and energy transition. It can support societal cohesion and innovation. It can create good jobs, sustainable and inclusive growth, and the political stability our democracies depend on. Finance is a key to a secure future, but only if we channel it with purpose. European finance has the tools we need. We are the world's largest single market. We have deep pools of savings. We have world-class financial institutions. And we have a growing community of investors who want to put their capital to work for long-term sustainable outcomes. But we must act. We must unlock capital faster. We must close the innovation gap with global competitors. We must build a deeper, more integrated European financial system, not just to weather the storm, but to shape the future and to compete globally. This is what leaders like Letta and Draghi have made clear, and I fully support that vision. To succeed, Europe must put finance to work as a force of change, a force for stability through social cohesion, a force for growth through innovation, and of course, as a force for climate action, resilience, and global cooperation. That is why we are here today, to make sustainable finance not a niche, but the new normal made in Europe. Despite some recent backlash against ESG, we remain certain of its necessity. We do not see ESG as a trend. We see it as a strategic imperative and a moral one. And it is our responsibility as policymakers and economic actors to make finance work for the common good. This is where Luxembourg has a role to play. Our financial center may be small in size, but is large in reach, scale, impact and vision. We are a European hub with global connections, a bridge between investors and projects, between capital and innovation, between ambition and delivery. Our financial sector represents over 25% of our GDP and employs more than 70,000 people. Our fund industry manages over 7.3 trillion in assets. Over 70% of UCITS funds assets in Luxembourg are invested with ESG criteria, more than 3 trillion in total. This is not abstract, this is tangible. These are the mechanisms through which finance becomes a force for change. Finance creates good jobs in Luxembourg and across Europe. Finance, when used wisely, is a stabilizer economically, socially, and politically. But we must speak honestly about the world we live in, because our world is out of balance. We are witnessing the largest territorial war in Europe since the Second World War. We face geopolitical tensions, a reshaping of global alliances, and rising protectionism. Climate change, biodiversity loss, and energy volatility are testing our societies. Economic inequality is fueling discontent, and the pace of technological change is challenging our institutions. But fear is never a good advisor. Crises bring clarity. It shows us where we must act and what truly matters. That is why in Luxembourg we are acting. One of my first steps as finance minister was to launch a 10-point action plan for sustainable finance for my ministry, which I presented at this forum last year. It sets out clear priorities for the next 5 years. We are mainstreaming ESG. We are scaling finance with impact. We are developing innovation in instruments such as tokenized sustainable assets and sustainability-linked bonds. We are making sustainable finance part of every policy discussion. Our national platform, the Luxembourg Sustainable Finance Initiative, has launched a new 5-year strategy, a strategy focused on practical action, training, and strategic alignment for our financial center. We continue to develop our ecosystem through LuxFlag label, the Luxembourg Green Exchange, and education initiatives with our universities. We are not just talking about sustainability, we are delivering. One area I want to highlight is blue finance. Our oceans are under pressure, yet they are vital for biodiversity, for coastal livelihoods, and for global climate regulation. That's why Luxembourg is taking steps to integrate blue finance into our sustainable finance activities. We are looking into how we can support new funds and impact-driven partnerships. This is a clear example of how finance can support environmental protection and long-term prosperity. Sustainability is not just green and blue. It is also orange and pink. It's about women. It's about ensuring that the benefits of investment reach women, small businesses, and underrepresented communities. That is why we have launched a number of initiatives in gender finance. We have launched a gender finance task force with 7 active working groups. and we have created a Women in Finance Charter to gather data from financial institutions. That allows us to measure our progress. We also co-finance 2X Global and have extended our Climate Finance Accelerator to include social and gender smart fund managers. Because this is not just about fairness, it is about financial performance, economic resilience, and global stability. None of this happens in isolation. Luxembourg's role in sustainable finance is one of partnering and connecting with others. We need less red tape, faster capital flows, and a deeper internal market for sustainable finance. Regulations in sustainable finance are challenging. We know this. That is why we are actively contributing to making sure that we have smart and better regulation that matches ESG needs, yet is not overly burdensome. We must harness finance as a force for innovation, cohesion, and strategic autonomy. We must remain competitive and open, rejecting the idea of a fortress Europe. Luxembourg will continue to be a strong voice in Brussels for openness, for pragmatism, for a financial system that helps Europe shape its future with confidence. Far beyond finance, Europe is currently experiencing a new momentum. I firmly believe in this historic opportunity. We must seize it together and combine it with sustainability. Ladies and gentlemen, finance is a key to a secure future, not by itself, but through far-sighted policy, smart partnerships, and shared purpose. We now have the tools, the frameworks, and the expertise. What we need is resolve. This is not the moment to slow down. It is the moment to move on, to invest, to imagine and to build tomorrow today. For yesterday is gone. Our shared journey of sustainability has just begun. Thank you.
Thank you, Minister Roth. Now it's time to crunch the data. Once again, Luxembourg for Finance has partnered with New Financial to give us a comprehensive update on how deeply ESG has become embedded in financial markets, including an update on the level of public ESG commitment and of the hard value of ESG activity. Quite insightful, especially in light of recent political pushback against ESG and climate-related finance, which has created some tension and divergence between financial firms on both sides of the Atlantic, especially in the US. Meanwhile, over here in Europe, it seems that some financial firms are doubling down on sustainability, and I want to give you a few recent examples. German asset manager Union Investment dropped ExxonMobil from its portfolio after the company failed to meet its climate requirements. And then the world's largest sovereign wealth manager, Norges Bank, last year not only divested from 49 companies based on ESG assessments, it also recently raised and significantly strengthened its sustainability requirements for the some 8,700 companies it is invested in. And then a number of European and UK pension funds either already pulled mandates from US asset managers or put them under review due to concerns about their record on sustainability. So it's quite an interesting and dynamic picture. And for more on our reality check on ESG, I have the pleasure to welcome now back to the Sustainable Finance Forum, William Wright, founder and managing director of New Financial, who joins us from London. Warm welcome back, William. It's good to have you back with us. I know your team has done a lot of hard data crunching. You have the floor.
Thank you, Judith, for that kind introduction. And thank you to Luxembourg for Finance for the invitation to join you today for the Sustainable Finance Forum, and of course for partnering with us on this project. Ladies and gentlemen, good morning, bonjour, guten Morgen, good morning. My name is William Wright, and I'm the founder and managing director of New Financial, a think tank that makes the case for bigger and better capital markets across Europe as a force for social and economic good. Today, I'm going to present some brief highlights from our latest report, the third edition, of our reality check on ESG. Thank you to Senior Analyst Christopher Breen for his excellent work on leading this report. Now, as Nadia Calviño and Minister Roth have just reminded us, sustainable finance is one of the essential tools in tackling climate change. Now, you may all have noticed something of a backlash against ESG and woke capitalism over the past few years. So the aim of this report was to cut through the noise and to measure for the first time the actual impact of this backlash on ESG activity, and to analyze the size, the growth, the penetration of ESG in different sectors of banking, finance, and capital markets around the world over the past few years. So let's start with a summary of the key themes in the report. First, we look at the impact of the backlash on the level of public commitment to ESG across the banking and finance industry. Second, the impact on the hard value of underlying ESG activity in different sectors of banking and finance. And then third, we measured the penetration of ESG activity in different sectors. Fourth, we highlight the trillion-dollar question as to whether the growth in ESG activity is translating into actual implementation of ESG and sustainable finance strategies on the ground in the wider economy. And finally, we look ahead to what a more sustainable and durable ESG framework might look like. So let's start with the impact on the public commitment to ESG across the industry. Now, as you all know, there are hundreds of ESG initiatives around the world, and many firms have proudly signed up to them. We see this as the first step for any firm that is serious about ESG, as it's almost a cost-free step to take. Now, we found that the backlash against ESG has led to a decline in the number of firms that have signed up to these initiatives, with more than 160 firms dropping out of various initiatives since we last ran this analysis back in 2022. This chart shows the change in the proportion of a sample of more than 2,200 large firms that are signatories to at least one of the main initiatives around ESG. The grey columns show the level of public commitment in 2022, and the blue columns show public commitment in 2024. Now, you can see on the left-hand side, there's a slight decline in the public commitment of large European financial services firms, from 81% to 77%. But that's way ahead of the global average in the middle, where we've seen a fall from just over half to 45%, and the global average excluding Europe, which has dropped from around 40% to just 1/3. Broadly speaking, in terms of public commitment, we're back where we were in 2021. Now, this chart shows the same trend across different sectors, and you can immediately see a wide variation. 80% of the largest asset managers around the world are still publicly committed to ESG, slightly down from 84% in 2022. But that is a long way ahead of pensions, where there was a big fall to just 43%. And we should note here that that has virtually halved since this public commitment by pension funds has virtually halved since 2021. Banks are down to less than 1/3, insurance firms down to just 1/5. So overall, perhaps not a great start. So what's happened with the value of ESG activity? Has it followed the same path? And the encouraging news, I think, here is that no, it hasn't. After a big drop in activity in 2022, which was as much down to the wider market climate, the invasion of Ukraine, as anything specific to ESG, ESG activity has proved remarkably resilient. In the past few years, despite the backlash, the value of ESG activity has actually grown in real terms. This chart shows the value of global ESG labeled bond issuance over the past 6 years. And there are clearly two different periods. The explosive growth in ESG issuance in the 3 years running up to 2021. And then secondly, that was followed by a steep fall in 2022 and a reset in the growth trajectory of ESG activity since. And this trend is reflected in most of the sectors of activity that we looked at. These charts show the evolution of designated ESG activity around the world over the past 6 years in real terms, for government bonds, for corporate loans, corporate bonds, and the assets of ESG investment funds. Now, there's a lot going on in this chart, but if you half close your eyes, you can see that the trend is fairly consistent. Rapid growth from 2019 to 2021, a steep decline in activity in 2022, followed by a flatter growth trajectory since then. In each sector, ESG activity is 2 to 3 times larger in real terms than it was back in 2019. And in every sector, despite wobbles in ESG investment funds and corporate loans, activity grew in real terms last year, a nice positive surprise given the mood music. So what does this mean for the penetration of ESG activity? Now, in our last report, we noted that ESG had effectively become part of the furniture in capital markets, particularly in Europe. This chart shows designated ESG activity as a proportion of all activity in different sectors in Europe, that's the blue bars, and at a global level, the gray bars. On the right-hand side, it shows the equivalent level of penetration in 2022 in red. And 2 things stand out for me from this chart. First, in every sector, Europe and particularly the EU is well ahead of the rest of the world, with penetration levels for ESG activity of double or triple the global average. And second, on a less positive note, there's no escaping the fact that penetration has fallen in most sectors compared with 2022. In the 8 sectors that we looked at, penetration was slightly up in 1, a slight increase in European investment funds, flat in 1, that's global investment funds, and down in the remaining 6. So how does this rapid growth and flatlining penetration translate into the implementation of ESG? Now, ultimately, it doesn't matter how publicly committed financial services firms are to ESG or how much labeled ESG activity is going on, if that doesn't translate into concrete change, concrete actions on the ground in the wider economy. Now, measuring implementation is hard, but we looked at it from 2 perspectives, and we're concerned by the development or lack of development in each of them. This chart shows the proportion of a sample of 200 large financial services firms that actively engage with their portfolio companies, borrowers, or corporate clients on their decarbonization targets. And we think it's concerning to see that only 43% of asset managers and scarcely a quarter of pension funds are actively working with investee companies on net zero. And second, we looked at the amount of financing raised by 2 different baskets of companies around the world. The first basket that we simplistically called good ESG companies. These are companies whose primary activity is addressing environmental and social issues, such as renewable energy or recycling firms. And second, bad ESG companies. These are companies whose day-to-day activities make climate change worse and delay net zero. And what we found is that the proportion of money being raised in global capital markets by good companies has fallen slightly since 2022 to just over 4%. But the proportion of money being raised by bad companies on this definition is basically unchanged. So despite the resilient levels of ESG activity, the ratio of funding for bad companies to good companies has widened slightly to over 5 times. In other words, for every dollar raised in the capital markets by a good company, more than $5 was raised in the capital markets by a bad company. And finally, in the wake of the backlash against ESG over the past few years, we mapped out a roadmap towards a more sustainable and durable framework for ESG. Now, I'm not going to run through this blueprint in detail, but here are 5 broad themes that we explore in the report. First, the idea of less is more, reducing the complexity, the burden, the overlap in the regulatory frameworks around sustainable finance to ensure that they are incentivizing concrete action rather than just incentivizing ticking boxes. Second, given the increasing role of private markets in investment activity around the world, ensuring that we don't end up with a binary system of public versus private markets when it comes to ESG frameworks. Third, balancing the trade-offs, raising awareness and improving the framing of the inevitable trade-offs that exist within ESG and sustainable finance. Fourth, and I think this point is absolutely crucial, is ensuring that the financial services industry is not designated as the guardian or the enforcer of government policies around sustainable finance and ESG, and that instead ESG is framed and evolves as a series of guide rails or guardrails for running a sustainable business for the longer term. And finally, exploring how Europe can build on its position as the clear global leader in all things ESG and sustainable finance, particularly given the political shifts in the US and elsewhere. So that's a quick summary of the main themes, the main findings from the report. My main takeaway is that I was pleasantly surprised at the resilience of underlying activity, and that the recent backlash is perhaps an opportunity to reset ESG, to reboot ESG, and to develop a more sustainable and more impactful framework for ESG for the long term. The report is available on our website at newfinancial.org and on the LFF website. Thank you for your time today.
Excellent. Thank you so much, William. And also shout out to your team for the hard work and effort that has gone into this report. Allow me to follow that up with 2 questions. In the previous report that was 2 years ago, you already pointed to a potential challenge for ESG in the coming years due to what we describe commonly as the political backlash. Do you see a new challenge arising on the horizon that could be of importance for the ESG community for sustainable finance in the next years?
I think building on the trends that we've seen around the politics of ESG and sustainable finance and the pushback against it over the past few years, I see that there is a sort of growing tension, a growing gap between the political pressure around ESG on the one hand and the underlying commitment that you mentioned in your introduction, particularly of asset owners and pension schemes to ESG. And that commitment is not to ESG as a framework or ESG as an industry or a product in its own right. It's a commitment to ESG in the form of the guide rails, the guardrails that I talked about, that I mentioned earlier, in terms of how best to run a sustainable long-term business. And I think the real challenge for ESG over the next few years is going to be ensuring that that gap, that tension, doesn't stretch too far. If it does stretch too far, we could find us, it could snap, we could find ourselves effectively with an irreparable divide. But I hope that the ongoing commitment to ESG, the underlying principles behind ESG, will survive and thrive on the other side of the political debate around ESG.
And to tie that back to your point that you mentioned earlier about European leadership, do you think Europe is ripe and ready, if you will, to forge its own vision about the future of sustainable finance rather than allowing this vision to be shaped by activities elsewhere in the world?
Yeah, whichever way you look at it, and whichever way we have looked at ESG or green financing in different iterations over the past 5 years, Europe, particularly the EU, is very clearly the global leader, the pioneer in sustainable finance and ESG. And the challenge, I think, for Europe today is to assess whether the backlash, the political opposition in other parts of the world is sufficient cause for Europe to rethink, to wind back on its position. And what I hope and what I think we're beginning to see is a degree of confidence in Europe, in the EU, to define its commitment, to redefine its commitment to ESG, to simplify the framework, to focus that framework on encouraging and incentivizing action, not just reporting for the sake of reporting, but to redefine its position on ESG and sustainable finance, not strictly in relation to or in response to what's going on elsewhere, but on its own merits. And I think we can see in the commitment by the European financial services industry, by asset managers, banks, insurers, this is not just a regulatory project. There is a real underlying support in the European financial system, in the wider European economy, for ESG and sustainable finance. And there's an opportunity for Europe to build on that, rather than risk it being undermined by the political challenges that it's facing around the world.
Terrific points, well made. Thank you so much, William Wright.
Thank you.
But please don't run away just yet to read the report. Leave that for later because we are just getting started. And I want to set up the first conversation we're going to have with reminding ourselves of the 2019 Green Deal, which set the EU on course and on the path to cut emissions by 55% by 2030 and indeed reach climate neutrality by 2050. To underpin this commitment, the EU aimed to mobilize at least 1 trillion euros in sustainable investment by 2030. And just recently, the Commission announced that Europe is broadly on track to reach that 2030 emission reduction target, with solar and wind power build-up playing a major role in this progress. But there are 3 caveats. One, some of that progress could at least partially be down to production and therefore emissions moving elsewhere. Secondly, more effort and capital is of course needed to proceed further on the path to a low-carbon economy. And thirdly, there's a bit of concern that efforts to simplify the EU sustainable finance regulatory architecture through the Omnibus package could have unintended consequences and potentially undermine the Green Deal. So our first conversation aims to make sense of these dynamics, and to lead the conversation, I'm delighted to welcome back Simon Mundy to this forum. He, of course, joins us from London as the editor of the FT's award-winning Moral Money newsletter. And you should know that he traveled the globe for 2 years to gather first-hand evidence of the climate crisis and give a voice to the humans affected by it and talk to them about the solutions they are working with. You can read his account in his book, The Race for Tomorrow, a journey through the front lines of climate change. Simon, warm welcome back. Good to have you with us. And I want to hand over to you with a quote and a question. Earlier, Nadia Calviño described in her keynote how investors truly are lining up for those sustainability-linked securities. And she said, and I quote, "These securities are creating a European safe asset and increasingly deep and liquid market under a European flag." And here's my question. Are these capital flows robust enough to meet the ambition of the Green Deal? And with that, Simon, you have the floor.
Thank you very much, Judith. It's great to be back with you all at SFF, and a really powerful and important question that you've posed for us there. I'm really pleased to have this opportunity to discuss it with Karl-Oskar Olming, who's the head of sustainability strategy and policy at SEB. He's also a member of the EU platform on sustainable finance, which has been doing some really interesting work in this space, and glad to have a chance to hear from him a bit more about that work. But Karl-Oskar, if we could just start with that question that Judith posed there. Judith also mentioned this important update that we've seen recently from the European Commission, in which they've said the EU appears to be very nearly on track for its climate targets. But if we look in particular at the capital flows around that, are these going in the right direction? Do these seem to be on track vis-a-vis where they need to be?
Thanks, Hamon, and that's a great question. We took on this kind of task in the platform of sustainable finance to monitor capital flows to sustainable investment. And the idea was really to make sure that we have some evidence on where we're heading in this space. And our report came out this spring in March. And what we could conclude with 2023 year's numbers is that, yes, we are making progress. In 2023, there were investments of 250 billion euros that were taxonomy aligned, so taxonomy aligned capex. And that's the first time really that we can compare these numbers year on year. That's a 34% increase compared to the year before. So there is substantial investments going on. At the same time, we also developed a methodology to understand, is there additional capital that might not be green as in the taxonomy aligned capex, but still contributing to the transition? And we developed a methodology based on the platform's report on assessing credible transition plans, where we could denote another 200 billion euros that are also contributing to the transition. So the numbers are quite significant, but they are not meeting the total investments that we need to reach the EU goals. That's on the investment side. But then we also have the financing side. So where is this money coming from? And here the picture is quite interesting. We looked at the whole green debt market. So both looking at loans and bonds, so green loans and green bonds. And here I must say that Europe is really a front runner. We could conclude that today we have a green debt market of 1.7 trillion euros. So that's the total outstanding green debt. And if we break that down, about a little bit more than the half is coming from loans, and then another half is bonds. And if we break down the loans even more, half goes to the private households, mainly mortgages. They're easy to measure, and the rest, the other half, is going to corporates. So we do have quite significant kind of financial markets. And then if we look at the flows, we see that around 200 billion euros each year are going to green bonds. And if we half that, we could conclude, not with really good numbers, but around half that is going to private equity. So different types of private equity in the space of kind of climate and green and so on.
So that's really helpful to give us a sense of the size of the flows that we're talking about. I suppose cynics might wonder, just because something is aligned with the EU taxonomy or aligned with even with a broader measure, as you've mentioned, of what could be driving forward this kind of progress, is it necessarily leading to real world decarbonisation, especially in light of, as you mentioned, or as Judith mentioned earlier, concerns that emissions cuts within the EU might simply be offset by emissions increases elsewhere as the EU effectively outsources its manufacturing. Is it possible, and have you been able to draw a clear link between these flows of capital that we're talking about and real world decarbonisation? How hard is it to make that connection really clear?
It's an important question, because first of all, one needs to distinguish between the secondary market and the primary market. The primary market provides kind of real cash, real money for investments. So looking at the secondary market and funds and so on, it's very difficult to really say what is the effect of owning a stock that has a certain capex. But if you look at bonds that are issued by companies that are actually using that use of proceeds for green activities, then there is a strong link. However, also for bonds and loans, there is refinancing. So you might actually pay back an old bond with refinancing a new bond. So it's impossible to say that everything in the primary market goes to new investments, but most of it, especially when you can say that it goes to taxonomy line activities or investments, that it will go to areas that will really contribute to change.
Now, we've mentioned the European sustainability disclosure regulations and the taxonomy that's very important here as well. And as Judith mentioned in her introduction, we're now seeing a reconsideration of various aspects of those regulations through the so-called Omnibus bill. How significant do you think these changes are? Do you think they're positive changes? And if we look at these types of disclosure regulations, how important have they been more broadly when it comes to mobilizing these capital flows that we're talking about?
Well, first of all, one interesting point is how do companies finance themselves? Are they financing themselves with capital from outside, or is it from internally generated means? And when we looked into a couple of sectors, we could see that over time, the main way of financing yourself is actually through your positive cash flow. So first of all, I think we should just be careful with putting too much of an emphasis that if we get the financing, kind of the financial markets right, everything will happen. We need to also consider how do we make sure that companies can actually retain as much of the money that they are creating themselves for investments. That could be tax credits and so on. But once we start looking at the financial markets, a main part that I want to drive through here and that I think is very important is what is driving investments in the real economy? And that was your starting question. Well, when we looked into this, it's not really a lack of financing of the large listed enterprises. When you go down to mid-caps and SMEs, yes, there are issues there. But for the large ones, the big issue is, do they have investable projects that are profitable long-term? If they have that, they will find their financing. So first of all, I think it is important to get the kind of the incentives in the real economy right. Then once we move to the capital markets and the financial markets, what is important? Yes, I think that the sustainable finance kind of framework has helped because it has provided logic and information to investors to make the right decisions, not basing it on information which are sometimes very difficult to interpret. So I think it has been important to have this sustainable finance framework, but now we are seeing this omnibus package coming, and what effect will it have? Well, I can only say that as far as we know today, it's basically about deleting some parts of the framework, de-scoping the framework, so removing the SMEs and so on, and delaying the framework. As you say in the UK, the proof is in the pudding, and we're still waiting for the real simplifications. The simplifications of the CSRD, where they're actually making changes that makes it simpler to disclose. And that takes time. Now, EFRAG is supposed to come out in October with their proposal, and I don't envy them, because writing regulation is difficult, simplifying regulation is difficult, and I think here the Commission can learn a little bit from the past. Maybe they've been a little bit too ambitious in terms of time in order to develop this, and I think that's what we have to kind of redo now, the fact that there wasn't enough time to really check and involve stakeholders. And now they are having very little time to redo it again, and I really hope that there will not be unintended consequences in redoing the EFRAG. But the simplification, I'm still looking forward to see what simplifications are coming out there.
Now, there's been a sense that some people have around green policy that the EU has been all sticks rather than carrots. There's been a focus on various sorts of regulation rather than providing the sorts of financial incentives and support that we've seen in different ways, obviously, in the US and in China. But that's an oversimplification, isn't it? I mean, the EU has been doing various things to support green innovation and investment beyond simply regulation. But I'd be interested in your sense of whether the EU has done what could be reasonably expected to really provide that support and incentive for this kind of green investment. Do you think there are other things they should be doing much more of?
Your question is whether it could be expected or not. I think the Commission, they are working within the frameworks that they can where they can operate, and the Commission, they have a lot of mandate to regulate, but they have very little mandate to actually, or none at all, to do taxation and so on, which means that the incentives they are providing, they are taking from the EU budget, and that's it. And we know that even though the EU budget is large, it has its limitations. So I think even though the EU would like to do more, they can simply not do so much more if they don't get into kind of the tax area. And I think we learned a lot from the Inflation Reduction Act in the US, where they basically said, we are providing you with tax credits. And the beauty in that is that it means that you only provide some kind of tax credit once the business is up and running and it works. And it means that you're not throwing funds after something that might or might not work in that sense. So I think the EU is doing a lot of things where they have the ability and the mandate with different types of EU funds, and now they are also starting to borrow on behalf of the EU, or which they did during the COVID. I just find, and what we are seeing right now with the new Clean Industrial Deal, for example, and a few other examples, is they are moving much more not away from regulation, but less of regulation and simplification in terms of regulation, and more in terms of looking how do we create the business environment to create these profitable investments. So I think they have made their lesson, but it's still a matter of being able to implement on it.
So for SEB, as a really interesting example of a major bank in the European Union, how are you looking at this? What are the opportunities that you see insofar as you are providing capital flows aligned with the European Green Deal? What are the attractive opportunities that you've been finding?
Well, if I go back to our report first, I mean, there we saw, when it comes to taxonomy line capex, the energy sector or kind of the power generation sector and manufacturing, car manufacturing, they are really industries where having a lot of taxonomy aligned capex. So those are sectors that are already kind of doing the transition, and then there are other sectors to follow, but they are not really there yet for technology or other reasons. What I find interesting right now is that we have been for a long time seeing how kind of the whole renewable energy has been a booming space, but now it's maybe more going into how to make sure that we get a robust energy system with a lot of renewables. So storage is there. How can you have both battery and peak, gas-fired power plants, working together, or if one fails, or not fails, but when you need to do it longer, those kind of investments are now becoming very interesting. Other areas that we are definitely seeing is the whole transport sector, although it's a little bit kind of not in a waiting mode, but we have seen a lot of investments in that space. But what we're expecting a lot is on the area of water and the whole kind of EU strategic autonomy, water, minerals, but also kind of the strategic autonomy around food is very interesting, and see where that is going to land.
And how far would you say the decisions that you'd be making at SEB, the opportunities that you see, and the opportunities that other financial institutions are seeing. How far would you say these are really being fundamentally shaped by things that are done at the European Commission level, or in terms of legislation that's introduced at the EU level or at national level? How far is this really being shaped by policy, or how far is it really things that are out with that scope?
I think the underlying fundamentals are shaped by business technology, business models. However, regulations are definitely kind of pushing different sectors in a certain direction. But I would say that when we look at this, it's dangerous to only rely on regulation, as regulation might also change over time. So we need to see kind of the business fundamentals in this, and that's where I come back to. It's really important that when the Commission is working on this, they need to work on how to make sure that the incentives and the business environment in certain sectors are the right for making these investments. It's less important, I'm saying, for the financial sector to label it in a certain way. For the financial sector, the disclosures are important. So it's important that we have disclosures and that we get the information that is relevant for making our decisions. And from in that context, we'll see how it will look like with this omnibus package, because on the one side we are getting fewer companies reporting. On the other side, we know that there will be now a voluntary standard for SMEs and those that are not reporting on the CSRD, which I believe will be an important standard and will cover a lot of the information that we as investors or financiers need in this space.
I was in Brussels a couple of months ago, and I was struck by how often I heard the word competitiveness. It just seems to be the buzzword, and actually, it was increasingly so last year already in Brussels, but now it's clearly the word of the moment. And of course, there was this very significant report last year written by Mario Draghi, former ECB head and Italian prime minister, on this question of European competitiveness. And he made it very clear in that report that he thought that the competitiveness drive should go hand in hand with the decarbonisation drive. But he also explored in very interesting ways this question of whether Europe should try to be competitive in everything when it comes to the low carbon economy, or whether it should really pick areas that it could focus on rather than trying to compete head to head with China on every area of the green economy. So when you look at this, both in your role at SEB and simply more broadly on the platform and just analysing the general European situations, would you break down the clean energy sector into areas where the European Union should really focus and areas that really it should just leave because they're going to be done better in other countries?
I mean, this is a very broad question. But generally, I think we need to understand that in some technologies we are maybe 5-10 years behind China, for example. And the question is, should we now try to build up something and kind of race against them, or rather do just as the Chinese have been doing? Make sure that we get Chinese investments, but also with technology transfer and know-how and so on. I think we need to work on both areas, but we cannot kind of we need to work with those that have the cutting edge on different know-hows and technologies, and we need to find ways of getting investments in Europe, whether that means that it's European investors or European technology or Chinese. But I think it is important that we get the know-how and the technology to Europe. With that, we're getting off spins, we're getting kind of new companies starting up and so on. And I think that is a better way to go than only focusing on us doing everything, because we know from history that it's difficult to be best at everything.
Yes, yeah, that's a very important point for the European leaders to bear in mind, I suppose.
But I think another thing in this area is, at the same time, we are, compared to the Draghi report a year ago, we have a totally different geopolitical situation today. And this is not really about sustainable finance, but the amounts we're seeing going into defense, resilience, and security are significant, and that will be with a main kind of focus on European manufacturers and European companies and so on. So there are some areas where this is a non-negotiable, more or less, while others, I think, it is possible to find these collaborations.
Thanks very much. So you mentioned the enormous change that we've seen geopolitically over the past year. And obviously that's been, I think you'd agree that the single biggest factor there has been the election of a certain Mr. Trump back to power in Washington. And that, of course, has to some extent driven and to some extent coincided with a quietening, to put it mildly, of communication from a lot of American companies around all things sustainability and climate related. I wonder to what extent you think something similar has been happening in Europe, where compared with, let's say, 5 years ago, financial companies are showing less appetite for climate related and decarbonization related investment, or how far you think actually the momentum is still just as strong, perhaps even accelerating in some areas?
I think that the European financial industry generally is kind of keeping its direction, but I think it has been a sobering in the last 5 years. I think we have realized that we are not driving the transition. It's the companies that are driving the transition, but we can provide advice and we can be an important partner in this. And as we see, or as the financial sector see that the companies are now not able to reach the targets that they have set, there are implications. What are we supposed to do? And this realization that we are not more than our portfolio. But the difference is that if you compare it to the US, we haven't changed the language very much. I think most European banks and financial institutions, they are keeping to their targets. We know that the Net Zero Banking Alliance and so on, it has kind of reduced the governance of it. It's a softer language, but it's all still there. And now it's also part of EU regulations in terms of what the European Banking Authority and others and ESMA are putting on the financial institutions. So basically, we have now institutionalized what we a couple of years ago came up with. Voluntary principles have now been institutionalized in regulation. So I think it's here to stay. I also think that we have kind of sobered up also in terms of being much better in general in the financial sector to understand where are the kind of borders of greenwashing and not. There have been cases in the last couple of years on this, and I think in general, what I'm seeing is that the market is much better in saying, that should not be labeled as green and so on. So I think in general, a sobering up and an understanding of the role of the financial sector, but at the same time, the direction is still there.
Thank you very much, Karl-Oskar. It's a really, really interesting time to be having this conversation. And as you said, we'll have a lot more to look out for in the months ahead. In the meantime, thank you very much for making time to speak with us today. I think we packed a lot of insights there from you into a short time. So thank you for that. Now back to you, Judith, in the studio.
Thank you so much, Simon Mundy and Karl-Oskar Olming. And Karl-Oskar just gave us the cue for the next conversation, which is labels. Now, sustainable finance investors have come to rely on a range of tools to measure ESG and understand sustainability credentials. And of course, they include labels and ratings and provisions set out by the EU taxonomy, by the Sustainable Finance Disclosure Regulation and the Corporate Sustainability Reporting Directive. And I should add that currently ESMA, the European Securities and Markets Authority, is working out technical rules for the ESG Ratings Directive, which the EU adopted in late 2024. And going forward, the EU Platform for Sustainable Finance has proposed to create categories under SFDR that can easily be understood, for example, by retail investors. And it also suggested to define impact investing at EU level in response to more and more investors aiming for measurable real-world impact. So it's all a work in progress, and our next panel will try to make sense of this progress and the future role of these tools in a changing market and regulatory environment, and crucially, which steps may be needed to ensure trust and transparency in sustainable finance. And as moderator, I have the pleasure to welcome back another familiar face to this audience, asset management editor Harriet Agnew from the FT, who joins us from London. Harriet also writes the weekly FT Asset Management newsletter and helps to oversee the future of asset management conferences in London, Abu Dhabi and New York. So warm welcome back, Harriet. Good to have you back with us. And I hand it over to you and your panel.
Thank you, Judith. Hello, everyone. I'm Harriet Agnew, Asset Management Editor at the Financial Times in London, and I'm delighted to be here with you all today. We're going to talk about the future role of ESG ratings and labels in a changing regulatory environment. And I'm delighted to introduce the panelists I have with me today. Hortense Bioy, Head of Sustainable Investing Research at Morningstar Sustainalytics. Didier Millerot, Head of the Sustainable Finance Unit at the European Commission's DG Fisma. Denise Vos, Chairwoman at LuxFlag, and Safaya Zaitoun, CEO at Tameo. Now, I would like to start by asking Hortense to share with us some data on what the sustainable investment landscape looks like today, and what are some of the trends and products that are in favour.
Sure. Thank you, Harriet. So maybe I can start talking about the landscape of ESG funds in terms of flows and assets. So for the first time, flows into ESG open-end funds and ETFs in Europe turned negative in the last quarter of the year, up to about $2 billion. It's not much, but also we saw outflows continuing in the US for the 10th consecutive quarter, with withdrawal reaching $6 billion in the last quarter. And all of this while the rest of the market registered massive inflows. So several factors can explain the declining inflows and outflows that we've been seeing in the ESG fund space over the past 2-3 years. We've got greenwashing concerns, ESG fund performance, which has been mixed and sometimes actually disappointing, especially in some key sectors such as green energy and green tech because of interest rate, but also other factors. With SFDR, we've seen a lack of clarity about definition, and that has led to confusion among investors. At the same time, an anti-greenwashing sentiment coming from the US has also grown in Europe. So all these factors have prompted some investors to reevaluate their positions, resulting in lower inflows or also outflows over the past 2.5 years compared to historical levels. So when we look at assets, though, we can see that assets still remain quite high. At the end of the first quarter, they were at $3 trillion globally. Now, we may see these assets decline a bit in the next few months because of the ESMA funding guidelines. We've already seen 880 funds drop the term ESG from the name in the past year. 880 that changed their names, including more than 500 that dropped the ESG-related terms, and that will have an impact on our universe. Now, against this backdrop, I think it's important to say that despite the concerns that I mentioned earlier, we need to keep in mind that there is still a high appetite for sustainable investments in both the retail and institutional space. This is what surveys show. The latest survey done by the Morningstar, the latest survey done by the Morgan Stanley Sustainability Institute, which was published a few weeks ago, showed that 88% of investors globally are interested in sustainable investing, with more than the half saying that they are very interested. So I think there is a bit of a disconnect there between the recent outflows that we've been reporting and what investors' intentions really are. Now, when we look at the products that are still in favor, we're seeing that light green products, funds that do ESG integration while applying some exclusions, remain popular. Fixed income ESG funds also continue to gather money. Fixed income ESG funds have consistently shown resilience over time. And this trend underscores, of course, the bond market's continued role as a key investment focus, especially within sustainability-linked frameworks, as it offers both yield opportunities and defensive positioning for cautious investors. Climate transition strategies also continue to appeal to investors. Climate transition funds invest in or tilt towards companies that are better prepared for the low carbon transition, typically focusing on low carbon and transition businesses. And transition funds offer broad and diversified market exposure to the market, which appeal to investors. That is in contrast with darker green sectors or types of strategies like clean energy, clean tech, and climate solutions, which are seeing a continuous decline, primarily because of performance. So I'm going to stop here, and I'm sure we're going to talk about some of those trends in more detail in a moment.
Thank you, Hortense. That's a very detailed and helpful overview. Now, when we think of ESG labels, perhaps, Denise, it would be helpful if you could explain to us what a label is and what a label isn't.
Thank you, Harriet. So, first of all, what is a label? So labels are credibility, lending credibility to financial products, i.e. the investment fund does what it says on the tin. And as such, labels can actually be an anti-greenwashing tool. So there are two very important factors that define really a component of labels. First is a predefined criteria, including, for example, excluding investments in controversial weapons such as cluster munitions, controversial behaviors such as human rights abuses. And then the second very important element that makes up a label is the verification by independent parties. In the case of LuxFlag, for instance, the labels applications are verified by our internal team of experts and then validated by an eligibility committee that is comprised of external specialists. In contrast, though, in spite of the fact that SFDR Article 8 and Article 9 have been used and are being used as labels, they aren't labels, given the scope of SFDR is disclosure and transparency. There's no defined criteria, no set of exclusions that Article 8 and Article 9 funds must ensure that they do not have in the portfolio. So that's sort of a summary of what a label is and what a label is not.
Thank you, Denise. Now we're going to hear a lot today about the ESG backlash and the implications of that. And I'd just like to hear from all of you, really, how do you think the ESG backlash will impact the business of ratings? Sophia, would you like to start?
Yes, with pleasure. Thank you for the question, Harriet, and thank you to Hortense for the introduction and to Denise as well. I wanted to preface my response by talking about kind of my positioning in the market so that it's a bit clearer for the audience. So when I speak about vehicles, I'm focusing a lot more on a small niche within the broader sustainable finance market, which is private asset instruments rather than listed strategies. And there, the impact of the ESG backlash backlash is quite different, and the use of labels in general is quite different as well. So overall, what we see is that in the private market space, the use of labels is very different, and it's not as prevalent as it is in listed markets overall. We do see labels like those issued by LuxFlag, for example, used especially in the microfinance space of private markets, but other labels that are used less. And on the ESG rating side, we can see that most private market investors tend to rely less on ESG ratings that are publicly available, because the instruments that they invest in are not rated by mainstream providers, and so they use their own methodologies. However, what's quite interesting in this space is that the need for transparency continues to grow amidst the backlash, because those that remain committed to private market impact investing are folks that are really value driven, and therefore they would like the claims of sustainability or impact that they invest in to be credible. And therefore, I think that there is a space in the market to have more transparency around the methodologies that are adopted by rating agencies and by label issuers to address the needs of that slice of the market.
Thank you.
I mean, I can jump in from the label perspective. I mean, I think first of all, I think it's important to remember and recognize that a label such as a LuxFlag label is not for every single investment product. It obviously, the labels actually basically set out those investment funds that are leading the way, if you will, when it comes to ESG or microfinance, for instance. We do actually, so we still see interest from asset managers in labels. We also, interestingly, start to see more small and medium asset managers who have implemented ESG into their investment process. They have become very interested in having all of their investment products labeled, because that shows that it's a sign of quality for them when it comes to sustainability. And then maybe just a final, maybe more general comment. I think timing is everything, and I think that given the implementation of SFDR, it's taken us, 5 or 6 years to implement that. I believe that the integration of ESG factors into the investment analysis and decision-making process is actually quite well embedded by asset managers in their processes and within their financial products. And I think that asset managers now understand the information and the perspectives they can get from now having ESG, so non-financial factors as well as financial factors when they look at what they want to buy and sell. They can obviously, with an ESG backlash, they could ignore that information. But as I said, I think the ESG process is now well integrated into the way they do business from an investment perspective. So I find that quite positive, actually. So, thank you.
Thank you. Didier, do you have some thoughts on how the ESG backlash is impacting ratings?
Good afternoon, everyone. I mean, first you have to define what you mean by ESG backlash. The way we see it is that there still is appetite, interest in investing in ESG products, but there are issues around the complexity of the information which people receive, the credibility of the ratings, these kind of things, and this was already mentioned by some speakers, the fact that the current framework for defining what a sustainable investment product is was not designed with a view to put in place categories or labels. So there's a risk there of confusion, misleading information, which, and I hope to be able to speak about this later in this panel, which lead us to the review of the SFDR. And as far as ratings are concerned, as you may know, we have legislation that has started to apply in the EU on ESG ratings, trying to put more, let's say, transparency in this field. So let's hope that this will contribute to credibilizing the market.
Thank you.
Maybe as a representative of an ESG rating agency, I can say that the way that ESG ratings are used today compared to before shows an evolution in the sophistication of investors in general. Investors today are more sophisticated, and of course here I'm talking about the more institutional type of investors, and these ones are less interested in ratings, but more they're typically deconstructing the ESG ratings and really focusing on each pillar, especially the E and the S, and they're even developing more and more strategies that are using data that are related to each of these pillars across different asset classes. So as there's more data available out there, there's also more, as I said, sophistication. And when I say there's more data out there, it's there's more backward-looking data with disclosure requirements, but also more forward-looking data, which is what investors today are more interested in, especially when it comes to climate and the transition. So we're really seeing an evolution in the way data is used, and this is also reflected in the way ratings are being used.
Thank you. Now, Didier, last month the European Commission launched its call for evidence on the review of the SFDR, which is the Sustainable Finance Disclosure Regulation. It would be really helpful if you could talk us through some of the things that the Commission is trying to achieve here and what sort of things might be done.
Yes, indeed. Thank you. I mean, basically two things. First, there's the issue of the entity level disclosures which have been imposed by the SFDR and which may be seen as redundant compared to what is already required under the CSRD. So there will be an exercise of simplification and coherence as part of let's say, as a global effort of the Commission to simplify the sustainable finance framework. So that will be one important aspect. And second important aspect, which is relevant to this conversation, is indeed the work we are launching, the reflection we are launching on the possible introduction of products categorization, which is there to kind of correct the current situation where you have what was considered initially as fundamentally disclosures rules, requirements under the SFDR was basically turned by the market into some kind of pseudo-labeling system. And as was said by some previous speakers, this cannot really work because there are actually very limited criteria underpinning those disclosure rules. So we need to do something about it to ensure proper investor protection and find greenwashing. So the whole reflection is about how we could introduce some categories, 2 or 3 categories, how we can make sure that there's indeed enough clarity in the system. And you may have heard that we are thinking about having categories of sustainable products, transition products, and possibly a third category, some kind of a catch-all category that would bring together products that have a certain level of sustainable, let's say, investment policies, but would not fit the 2 first categories. So this work is still pending. We are consulting. The SFDR review has been announced for the end of this year, but we are a bit dependent on the outcome of the discussion in the context of the CSRD, because the CSRD is going to determine the scope of companies which are subject or not to entity level disclosures requirements in the sustainability area. So it's a bit difficult for us to move forward with SFDRs without having clarity about the scope. But I guess that once this is done, and we hope that this would happen by the end of the year, the SFDR review can be put into the public domain.
Thank you. And let's look at Article 8 and Article 9 funds, which again have come under more scrutiny. So broadly, Article 8 funds promote environmental or social characteristics, whereas Article 9 funds have an actual sustainable investment objective. I wondered what have been some of the main concerns here among regulators and end investors?
I can jump in. Oh, sorry.
No, go ahead.
Thank you, Harriet. I mean, I think if we are looking to raise large amounts of private capital to finance the EU Green Deal and the like, and we're aiming to attract retail investors, then I believe that a future version of SFDR could actually benefit from product categories. I know that not everyone agrees with that, but I think that if Article 8, Article 9 doesn't really mean much to the man or woman in the street. If you start talking about transition, that's much more evocative and much easier, I think, to explain, transitioning to a more sustainable world, transitioning to net zero, etc. So I think that actually could be quite helpful.
I do actually have a contrarian view on this one, and quite a strong one. I just think that will add complexity to the current framework. Actually, transition is a very emerging space. It is where ESG was probably 5 years ago with many different types of strategies, which I think will be very difficult to fit into one category with minimum criteria. I think if we look at what's happened in the UK with their labeling regime that has dramatically reduced the opportunity set for investors, and this is my concern that the same could happen in Europe. I think there are other things that can be done to help capital flow into more sustainable activities. There are things that can be done to simplify the communication with the end investor by simplifying certain terms. But I do not necessarily think that getting rid of Article 8 and 9 and replacing Article 8 and 9 by product categories will really solve the problem. I think it's going to create more complexity and confusion. And as we know, at the moment, there is a lot of ESG fatigue, and asset managers would struggle to implement that. The end investor will also struggle as well to understand what this is about.
Yeah, I really agree with a lot of statements that were being made. I think one of the core challenges that we face today, and Didier already pointed this out, is that people are using this classification of Article 8 and Article 9 for things that they were not intended for. So today they're being put in the market as de facto product labels, which creates more confusion for investors than it does bring clarity or transparency. I think it's important for us to remember that the main purpose of the regulation was to bring more disclosure and to prevent greenwashing, but in a strange kind of counterproductive movement, it's created tension for impact investing instruments, especially again in private markets, because they often operate in more complex and less data-rich environments, which don't lend them to be able to comply with the disclosure requirements, especially on things like principal adverse impacts. And so we almost create sort of an impact tax, if you will, increasing the operating expenses of these vehicles and creating more burden for them. So we find ourselves in a position where you have one end of the spectrum of folks who are overly conservative, and so they don't want to classify their vehicles as Article 9 at the risk of being declassified later on. And then we have others who are also doing a lot of impactful work, but that could be screened out because they cannot fully comply with the disclosure requirements. So I think there is a more balanced approach to be found, not necessarily by adding more complexity, but by providing clearer guidelines under SFDR with better fit for purpose for the market, distinguishing also between different levels of disclosure that are required for different types of vehicles.
Thank you. Didier, was there anything you wanted to add on Article 8 and Article 9 funds?
I mean, this is a nice summary of the debate which is taking place at the moment. Again, we have not made our mind yet on those categories. It's for next year, but our objective is certainly to enhance the understanding of those financial products by investors. Let's see if this goes into that direction. We will need to look at the criteria that will underpin those categories. So this is also something which is challenging. And I heard also the reference to the British experience, which is also something which we're trying to look at and try to draw some lessons from. So let's continue the discussion and see how we can best achieve, I think, our common goal, which is to indeed have attractive products that contribute to the financing of the green transition.
Now let's talk about defence spending, because this is an area that all governments across Europe have vowed to sort of ramp up spending on. Do you think that the regulatory landscape is up to date and in line with this priority? And what would you like to be done in this area to improve it?
I can go.
Thanks.
So, personally, obviously, given the situation today, I clearly understand the need to increase investment in defense spending. But, and I'm not, when it comes to SFDR, I think we've already clarified this is about disclosure and transparency. So I'm not, from the regulatory framework perspective, when it comes to defense investing, I'm frankly not really sure there is actually enough. But I think it's important from the asset management industry's perspective. The asset management industry actually clearly distinguishes between controversial weapons, such as cluster munitions, which are generally universally excluded by sustainable funds, not surprisingly, versus conventional weapons, such as handguns. I think that, though, investing in defense cannot actually be called ESG. This is my perspective, I guess, from the perspective of LuxFlag as a labeling agency. At the very least, when we're looking at the social aspects, i.e. killing people is not really an ESG plus, if you will. And we need to be extremely careful about that. There's nothing, of course, to stop investment funds from investing in significantly in defense companies, being set up and invested in by investors as defense funds. But investors in ESG financial products will not, I believe, expect to be investing in funds, their ESG funds that hold investments in defense companies. Certainly not companies producing controversial weapons. So I think that's a potential reputational issue for the asset management industry that needs to be watched very carefully.
I would concur with what was said. I think it would be better for the regulator to say that there is no incompatibility. But at the same time, when I hear the idea, the possibility that there could be another category that is created under SFDR, just to allow defense to fit into sustainability, I don't think that can work. I think it would be better just for the regulator to say, you can have a fund that invests in defense if the fund is not looking necessarily for a positive contribution to the world, i.e. it's not an impact fund. That's fine, but a sustainable fund, I don't see how an Article 9 fund could justify investing in weapons.
Yeah, I fully agree, and especially within the niche of impact investing within the broader market, I think defense or weapons in general are among the first items that fall on the exclusion lists of funds because they are fundamentally misaligned with the missions of the institutional investors that are interested in sustainability and impact, and misaligned with the whole premise of investing responsibly or sustainably. Is there a need need for an improved regulatory environment to mitigate any issues of allocating capital where investors don't want it to be allocated. Perhaps, I think it's perhaps too soon to say today, but we remain with the point that transparency is really key, because I think it's very misleading for whether it's retail or institutional investors to find out ex post that capital that they've put into sustainable strategies, or even worse, into impact strategies, are being allocated to defense, which I don't think would have been their intent.
Thank you. Didier?
Yes, very briefly on this important topic. I mean, our position is to say that our sustainable finance framework is basically neutral in this respect, and we do not prohibit, we do not encourage. It's in our view, it's an issue which is largely driven by investors' feelings and needs. We've seen an evolution of the thinking as regards the opportunity to invest in defense products over the years. Now it's something which has become more popular, and also this is something which has become a more, let's say, promising investment proposition when you see the performance of the defense industry. But we also are reluctant to mix things up, mix defense consideration with ESG consideration. So again, our position is to say that we are neutral. Our framework is available to defense companies, but they have to fulfill all the conditions. And there is this issue of the exclusion of the controversial weapons, which is sometimes considered as being unclear, and this is maybe something which we could address as in the context of future Commission initiatives. We may have in mind the fact that the Commission is envisaging an omnibus in the area of defense, which could indeed shed some further light on the actual scope of that exclusion. Thank you.
Thank you. Well, that was a great discussion, and I'm afraid that's all we have time for today. But thank you to the audience for joining us, and thank you to the panelists, to Hortense, Didier, Denise, and Sophia. And now back to Judith in the studio.
Thank you, Harriet Agnew, and her fantastic panel speakers, Hortense Bioy, Didier Millerot, Denise Voss, and Sophia Zeytoun. Now, earlier I highlighted that the focus of investors has been shifting from merely reducing emissions in portfolios to seeking diversification and real economy impact. And that's where transition finance comes in. Now, broadly speaking, what sets transition finance apart from green and mainstream finance? Well, in the words of Helena Fines-Fiestas, chair of the EU Platform for Sustainable Finance, she says it's about financing the journey, while ensuring it does not block the end goal. In other words, it's about enabling the decarbonization of critical sectors, think, for example, power, transportation, or industry, with a credible plan and pathway that avoids locking in carbon emissions in the longer term. But transition finance can also be an instrument for a sovereign issuer, for a country, to align with the path to carbon neutrality. Japan set a high bar in February last year, issuing the world's first sovereign climate transition bonds as a cornerstone of Japan's green transformation program, which aims to mobilize $1 trillion over the next decade in support of advanced sustainable technologies. So our next panel will dig deeper into how transition finance is evolving and what it has to offer to investors. And for that conversation, I have the pleasure to hand you back to Simon Mundy.
Thank you very much, Judith, and hello, everyone. Well, this is a big and important topic, lots to discuss, so let's dive straight into it. Really pleased to be joined for this conversation by Isabelle Millat, who is the Head of Sustainable Finance for Global Markets and Barclays Europe at Barclays Investment Bank, and Gabriel Wilson-Otto, who's Head of Sustainable Investing Strategy at Fidelity International. Isabelle, if I could start with you, transition finance is a phrase one's been hearing more and more over the past few years, but it's not necessarily obvious what it actually means. So could you help us with that?
Sure. Thanks for the question, and thank you for inviting us. Well, transition finance is critical because it's directed to activities that support greenhouse gas emission reduction in high emitting or hard to abate sectors. And these sectors cannot become immediately green, but they are essential to the economy, and they're even essential to the build out of green or renewable energy infrastructure. Typical examples are steel, cement, chemicals, but we'll get back to that. I would flag that these hard to abate sectors account for around 30% of global CO2 emissions. So financing them is obviously critical to net zero in 2050. And transition finance is a complement to green or sustainable finance, just because, as I said, it helps certain activities get from brown to green, or even brown to less brown. As we know, in a net zero world, not all activities are fully decarbonized. In that definition, really critical are credible transition pathways. So the transition must be underpinned by science-based decarbonization plans with long-term and intermediate targets. So just examples of these pathways and then credible scenarios are those from the International Energy Agency or the UN International Panel on Climate Change. I would also say that often transition finance is associated with the concept of just transition because it's also essential to preserve jobs and industrial competitiveness as the world decarbonizes. Lastly, of course, we know as new technologies are deployed, what is today transition might change. So we must remain on the lookout for these developments and update our definitions.
Thanks so much, Isabelle. That's a really, really helpful overview. So, Gabriel, could we drill down a bit? Isabelle's just given us a really great look at what this concept means in general. Could we drill down into some specific examples of sectors and industries that you find particularly interesting in this space, either ones that present particular opportunities or particularly difficult challenges?
Thanks for the question, Simon, and a pleasure to be here with everyone. I think that transition finance, as Isabelle was highlighting, is absolutely critical. And if we look at some of the sectors where this is most appropriate for financing at the moment and where we can have the most impact, the energy and transportation sectors really stand out here. So depending on how we cut it, energy going into other sectors is also generated within a specific sector is around 75% of carbon emissions. While that's a huge burden of the world's emissions, it's also a source of optimism because there are economic opportunities to decarbonize within that space, such as renewable power, energy efficiency, and other areas that we've seen deployed at scale. And we're now seeing clean energy investments significantly exceed investments in traditional fossil fuel sectors. So we are seeing a live example of that transition happening in real time. This also looks very different in different parts of the world. So a really interesting stat is that the global south has about 1/5 of the energy demand of the global north. So what this means is that as those economies start to industrialize more and more people are lifted out of poverty, provided with essential services and higher standards of living, that needs more power, that needs more energy generation. And so it's important to facilitate that just transition of decarbonizing within those local markets in a way that improves the emissions efficiency, but also provides the opportunities for local people to continue to see GDP development in other important areas. And in certain markets, this can be incredibly concentrated. So in home for me is Hong Kong. And within that market, we see that around 60% of carbon emissions are actually just from buildings. And so you see a huge opportunity for that retrofitting of the built environment as a way of improving emissions intensity and efficiency. And also nearby in Indonesia, 30% of power demand is from air conditioning alone. And so this just highlights the importance of this topic to everyday lives, but also how it's integrated into local economies in different ways. And there can be different transition and decarbonisation pathways.
Thanks very much, Gabriel. I would certainly be interested, and I'm sure a lot of people watching would be interested to hear a bit of detail about the ways in which each of your institutions is approaching this topic. Perhaps we could start with Isabelle on this. How does Barclays as a bank approach transition finance? What are the key areas in which you're supporting this kind of work?
Well, first, we have a transition finance framework where we lay out which activities fall into that category of those that are, on the path to decarbonization, yet not already fully green. Then second, we have a client transition framework and scores to evaluate the progress of clients in high emitting sectors as they transition to a lower carbon economy. And importantly, the scores are used in risk management processes, as well as to engage with clients. And I really want to focus on this opportunity that transition finance gives to financial institutions to engage with their clients on their strategies for decarbonization, also providing peer benchmarks. So it's a way to strengthen these relationships. I would also call out that when we make a choice to engage and support clients' decarbonization instead of just exiting them, it's a way to keep a diversified client base, but also to avoid what is sometimes called paper decarbonization, where you would decarbonize your own balance sheets with no real-world benefits. So really, we're trying to achieve, that benefit and that decarbonization impact through both the activity level transition finance framework, but also the client level engagement and then client transition framework.
Thanks very much, Isabelle. And Gabriel, would love to hear from you, without giving away any state secrets, details of how Fidelity approaches this area.
Thanks, Simon. So for us, there's really three main levers at Fidelity International that guides our thinking when we're focusing on transition finance. The first is integration. So transition will also result in disruption. This means that our analysts and portfolio managers need a suite of tools, information, in order to be able to assess how incumbents and new entrants will be impacted by the energy transition. So just as part of fundamental analysis of a company's future, we need to understand what this could mean. The second is looking at solutions. So this is how do we offer clients a range of products that meet their own decarbonisation objectives or provide access to companies that are starting to transition. So within that, we focus on certain funds that can be funds such as a climate solutions product, which is investing in companies that are providing the solutions of tomorrow to decarbonise. There are others which are looking more at climate transition, which are investing in best-in-class players within each sector, where they're adopting some of this technology and on that pathway to decarbonise. And that's really informed by some of our internal tools, such as a climate rating, which defines on a stepped scale the extent to which management's capital expenditure, governance, management and targets that they've set are aligned with decarbonisation towards some net zero. So this is a way that we're able to qualitatively and quantitatively classify companies for inclusion within products and also for risk screening as part of that first step of integration. The final component that we use is looking at stewardship. So this is how we can engage with both policymakers as well as with companies. So taking a systems approach to look at how can we effectively try and mitigate some of these risks, but also maximize some of the opportunities that we see for investments on behalf of our clients associated with the theme.
So if we look at the incentives that have led you to take this approach, how far would you say this is linked to the desires of your asset owner clients? How far are there policy or regulatory factors playing a role? How far is this simply a matter of you trying to make sure you're managing all material risks as appropriately as possible?
I would take all of the above as the options. Basically, what we're seeing is that certain countries where they've set aggressive decarbonisation targets, a lot of state-linked entities are now trying to rush to implement policies and plans that are associated with them. So to the extent that they're asset owners themselves, they can come to us with very ambitious decarbonisation targets that they're looking for solutions for. And this is not about decarbonising tomorrow. It's about how do they set themselves on that pathway to hit a 2030, a 2060 target, a 2050 target, depending on the country, in order to try and establish what that looks like for their own investments, their own loan book, their own portfolios. So that government-linked side is very, very interesting. Another component is around regulation, whether this is for asset managers, whether this is for insurers or banks, around transparency and loan composition and how climate risk is being integrated into portfolios. That's causing a significant amount of introspection amongst our client base to evaluate how should they be thinking about these sorts of risks and opportunities within their own operations. So I think that there's a range of different dynamics at play here. There's the state level ambition filtering down, there's regulation creating transparency and incentives, and then there's also the final bucket of pure fundamentals where people are looking at EVs, they're looking at renewable energy, they're looking at some of these sectors, and they can see the structural tailwinds and they believe that over time this could be an appropriate place to invest in order to see real capital appreciation. So this is some areas where we're starting to see different clients and different components of that playbook come together.
Thanks, Gabriel. And Isabelle, from your point of view, do you see this first and foremost as a means of managing risks for Barclays? Or is it more about this is an exciting area of opportunity to grow in this area?
Well, first, I mean, I totally second what Gabriel said, and just to complement, for sure, there's an element of managing transition risk, right? We know climate risk is financially material, so decarbonizing our client base and our balance sheet is a way for us to manage risk. But I'd like to really call out also the positive, and starting with investor demand, and also then commenting on policy support. So in terms of investment and investor demand, for sure, transition is still somewhat of a challenging space. I mean, data is not always there. We discussed earlier that definition can still be a challenge. However, I would highlight that investors are getting more and more focused on transition investing products, and our large clients are sophisticated asset owners and asset managers who've been pioneers in sustainable finance. So they're super thoughtful about how they can achieve greater additional impacts, and they're driven to transition finance because they reckon that investing in activities which are already green is not sufficient, as I said earlier, to meet the Paris goals. And they see that sometimes, green finance gets a bit more mainstream, but transition finance is still more challenging, and this is where the concept of additionality is key. These clients want to deliver decarbonization impact that would not have taken place without their investments. In addition, as you said, our clients, just like us, want to de-risk their portfolios, right? But beyond that, some clients even seek now to generate alpha by investing in each sector in companies that are maybe not yet best in class in terms of carbon intensity, but that are improving these carbon intensity scores. And that's really in the spirit of the Sustainability Improvers product category in the UK Sustainability Disclosure Regulation, actually. So just to conclude on clients, which is obviously the number one driver for us, they are driven to transition finance both by the impact materiality and by the financial materiality. Now, of course, there are also policy incentives, and that's important because in truth, some of these transition technologies are still nascent. So policy can help de-risk until the technologies scale up and become more economical on their own, right? I would like to call out that the policy support can be in the form of guarantees. So in Europe, the European Investment Bank is offering guarantee products for commercial banks who support climate tech or decarbonization technologies, right? So there are guarantees. There's also direct funding, as well as shifting government sourcing towards certain products. So just one example to really bring it home, about half of the cement used globally is procured by the public sector. So you can see how changing procurement towards green cement can be such a huge signal. In terms of policy, just to flag that it's not just the support, it's also the stability and visibility, which is crucial both to us, financial institutions, and to our clients to safely invest, right, in these activities. And yeah, as always, we need to keep on the lookout because of the volatility of this policy environment and the transition sectors and activities that it supports.
Thanks, Isabelle. You mentioned the word additionality, which is absolutely crucial here, of course. And I think some observers see a potential risk around transition finance, which is that financiers, financial institutions might provide finance to companies under the banner of transition finance, which isn't actually driving transition. It's just normal finance, really, which has some relatively weak metrics attached to it. So it's called transition finance, but it's simply financing business as usual. In theory, of course, there could be that risk. I presume that's not what you guys are trying to do at your respective institutions. So could you talk us through that, perhaps starting with you, Gabriel, to explain how you make sure that when you're providing transition finance, it really is, you can be confident that it is promoting transition and it's not simply financing business as usual?
Yeah, this is an incredibly important area. And so if we look at one of the challenges that transition finance has seen, I think Isabelle mentioned this earlier, in the absence of a framework to provide guidance as to what good transition looks like, and in the absence of those sector and country-specific pathways to guide transition, it really is incumbent on different financial market participants to create their own framework. So that immediately leads to a fragmentation of approaches within the market. So most banks and most asset managers have their own transition approach and transition finance metrics. So that can lead to an area of confusion or just conflicting expectations. The other point that Isabelle mentioned that's critical here is the potential for policy and frameworks to actually create that certainty under which to invest. So if we look at SDR, which was referenced, the introduction of an improvers category and some guidelines under what that can look like is starting to shape market expectations. So for us, when we look at transition within that context, we really look at it on two axes. So what we're trying to evaluate is what is the extent of the improvement? So what's the ambition and change that we've seen? And then to what extent is that deliberate? So what we ideally want is an improvement in underlying metrics and performance that is also a deliberate part of strategy. So if we're looking at what we can see within our climate ratings, this is why we look at whether there's a net zero target, whether the company has set appropriate governance structures in place, but then also whether CapEx is starting to follow these activities. So this is effectively another way that we can try and look, is the money following what the company is trying to achieve? And are we seeing the underlying metric addressed by that target start to improve? So that's the conceptual framework that we look for. That can mean different things in different sectors. So for example, if we look at transition or improvers within the context of ocean and river health or ecosystems and biodiversity, what we're trying to find is that same two-axis framework of trying to find where is the improvement deliberate and where can we quantify it. And for us, that's important as well, because what you also see is in a lot of sectors, incremental improvement over time purely as a result of grid decarbonisation or as a result of just the underlying efficiency of technology increasing, so a natural rate of decarbonisation. So we don't want to support business as usual. We want to support aggressive ambition that is delivering actual results. So that's how we try and frame it.
Thanks a lot, Gabriel. And Isabelle, you touched on this earlier. Would you like to tell us a little bit more about how you and your colleagues at Barclays aim to ensure additionality when it comes to transition finance?
Well, I mean, Gabrielle called it out. It's super important to rely on science-based, credible decarbonization pathways. So here, pace of decarbonization is of the essence. So we don't only define a high-level transition finance framework, we really break it down by activities. And then further, in each activities, we see exactly what can qualify, again, depending on how fast the activities decarbonize. And it's, when I say activity, it's quite precise. So I will give the example of real estate. So here it's about really specifically energy efficiency retrofitting of residential and commercial real estate, for example, or one that has not yet been mentioned, I think, is agriculture. So here, transition finance could be directed towards processes and technologies that reduce methane from livestock farming, for instance. So you see, it's really focusing on credible scenarios and then drilling down in each large categories into what are exactly the relevant technologies to decarbonize and how fast does the decarbonization need to take place. Lastly, and I touched on it earlier, there's a client element, right? Each corporate client is very specific, and this is why we have the client transition framework to make sure we give enough time to study each client and how they benchmark against peers in their industry.
Thank you very much, Isabelle. That's been a really useful conversation. Thank you to both of you. There is so much more to discuss, and I wish we had more time. Unfortunately, our allotted time is up, but we will certainly continue to explore the topic of transition finance here at the FT and in future editions, I'm sure, of the SFF. In the meantime, Judith, back to you in the studio.
Thank you, Simon Mundy and his panel speakers, Isabelle Millat and Gabriel Wilson-Otto. Now, the conversation about transition finance takes us straight to our next topic, which is sustainability-linked bonds, the smallest thematic label, if you will, in the whole family of sustainable finance instruments. Now, typically, SLBs use a mechanism, an incentive mechanism, I should say, that combines one or two KPIs, performance targets, and a penalty, which kicks in if one or several of these KPIs are not met. And that is what happened back in 2023 in what has been described as a watershed moment, both for issuers and investors. Italian energy utility Enel, which is a pioneer in the issuance of sustainability-linked debt and the most prolific issuer indeed, with some 28 SLBs, missed its greenhouse gas emission targets. And this triggered a 25 basis point step up in affected bonds, which means investors in some 10 of its outstanding SLBs now receive millions more in interest payments. Total extra cost for Enel to the tune of $90 million. So you can see there is an interesting dynamic here underlying. In our next conversation, we will learn more in detail what SLBs are about, what makes them work, why this year is a very specific and interesting year for SLB investors, and why Slovenia is planning to make history as the first EU member state to issue a sustainability-linked bond this year. Our moderator for this conversation is a veritable sustainable finance pioneer, Leatitia Hamon. Began her career in 2008, around the time of the last financial crisis, as an SEG analyst for an extra financial rating agency. After gaining experience with different firms, she spent 8 years managing and then leading the sustainable finance audit and advisory practice over at KPMG in Luxembourg. And 5 years ago, she joined the Luxembourg Stock Exchange as head of sustainable finance. And in this role, she leads the LSE's UN-awarded platform for sustainable finance, the Luxembourg Green Exchange, of course, and is responsible for the LSE's sustainable finance strategy. And I should add that Leatitia is also a member of the European Commission's high-level expert group on scaling up sustainable finance in low and middle-income countries, which presented its report last year. So please join me in offering a warm welcome to Leatitia Hamon and her guest. You have the floor, Leatitia.
Good morning, Judith, and thank you for the introduction. I have the pleasure today of interviewing Marjan Divjak, the Slovenia Treasury Director General, to discuss the upcoming issuance of the sustainability-linked bonds by the government of Slovenia. Good morning, Marjan.
Hello, good morning.
Hello. Now, to set a bit of background for those of you who are watching online, I wanted to explain very briefly what are sustainability-linked bonds. So SLBs are a type of instruments where the financial or the structural terms of the bond are tied to the issuer's achievement of specific sustainability performance targets, so SPTs as we call them. So just to give you an example, an issuer can commit to reduce its GHG emissions by 2030 by 30%. That would be an example. And unlike green bonds or social bonds that are where the proceeds should finance specific environmental and social projects, SLBs can be used for general purpose financing. But what really makes them unique, as Judith mentioned, is that if the issuer fails to meet its targets, then they may face a financial penalty, and in most cases, it's a coupon step-up that the issuer has to pay. So the first SLB was issued in 2019 by the Italian issuer Enel, which committed, in fact, to increasing its renewable energy capacity or to face a higher interest payment. In 2020, the International Capital Market Association issued the sustainability-linked bond principles, really to provide guidance to the market on how to structure these bonds and how to report and disclose on them, and make them more credible also on the markets. So after the SLBPs in 2021, we saw a peak of issuances of SLBs, but then after that, we really saw a decrease, a notable decrease of issuances in SLBs. Just to give you a few numbers before we start the conversation, since 2019, there was around 260 billion that was issued by roughly 400 issuers of SLBs through 820 issuances around the world. So as Judith mentioned, the SLBs are the smallest part of sustainable bonds, as they represent 5% only for the time being. But this year, 2025 is really paramount, is of very high importance because it will set a new record for SLBs in terms of targets to be due. So we are very much looking at this year, especially at the Luxembourg Stock Exchange. We produced a study in February this year to look at the market trends and understand what were obviously the main barriers to SLBs, but also, and most importantly, how to build confidence on the market and empower issuers on SLBs. So to discuss these SLBs, I'm very happy to have Marjan with us as a soon-to-be issuer of an SLB. As Slovenia has published its landmark sustainability bond framework very recently and prepares to become the first European sovereign to issue an SLB. So Marjan, Slovenia has a well-established reputation as an innovator when it comes to bonds, with already 2 use of proceeds bonds that have been issued and the first Euro area sovereign digital bonds. So this year, you plan to innovate again and tap into the market with a sustainability-linked bond as the first EU member state, and only a few other sovereigns have done that so far, such as Chile, Uruguay, and Thailand. So what's the rationale behind this issuance, Marjan? Why did you decide to go the SLB route?
Thank you very much for this invitation. It's my pleasure to be here with you. As you have pointed out, Slovenia successfully issued use of proceeds sustainability bonds. The first bond was issued in 2021 and the second one in 2023. We were able to improve the quality of the framework, aligning the significant contribution criteria to EU taxonomy, and obtain second-party opinion for that. So this went extremely well. The 2 bonds perform very well on the secondary market. Both outperform conventional comparator bonds, which are bigger in size. Conventional bonds are of size to 3 to 4 billion of euros, while sustainability bonds are of 1.25 billion issue size. But still, the two sustainability bonds outperform conventional comparators in terms of greenium, in terms of volume of trade, bid-ask spread. The two bonds performed extremely well during sell-off period when rates were rising. So on the back of this, the Republic of Slovenia has given a commitment to capital markets to appear every second year on the capital markets in ESG format. We stick to this commitment. The decision was between preparing the third sustainability bond of Slovenia or to actually add the new instrument to the toolbox of instruments, where I would like also to mention that the Republic of Slovenia issued samurai yen denominated bond in social category. So we have quite a lot of experiences when it comes to that. So the decision was taken to as I have mentioned already, to add to the toolbox of instruments, and if market conditions are good, if investors are ready to embrace this kind of an instrument, the Republic of Slovenia is to issue in the forthcoming weeks the first, as you have mentioned already, sustainability linked bond. The rationale, as I have mentioned, is coming from our commitment to capital markets to be every second year in the thematic segment of the market. And it is coming from our views, if you want, from my own view, that this type of instrument, sustainability-linked bond, can well complement the use of proceeds bonds. So with use of proceeds bonds, there must be eligible green and social projects available in budgets. So money must be put aside to invest to actually support the transition to net zero, while sustainability-linked bonds, sustainability-linked instruments are very much, in addition to the funding needed, related to decisions which policy makers must take to move decisively or more decisively towards global environmental and social goals. So in this context, in our view, the sustainability-linked bond can very well complement the existing instruments which are very much common to the capital markets.
Well, thank you, Marjan. I guess it's important as a message to mention indeed that these two types of instruments can be complementary because some issuers wonder which one to choose, but in fact they can also serve the same purpose. And I also think it's important to mention that SLBs can be a powerful tool for sovereigns to align their financial strategy with their climate goals as well. Now I read that your SLB should feature a coupon step up and a coupon step down. What can you share about the practical experience of setting this up, how to choose the targets and make them credible and ambitious? And maybe you can tell us more also about your experience with the second-party opinion providers and how important you think this is.
Yeah, so I think there are two very important aspects of any thematic bond, not only sustainability linked bonds, but any thematic bond. That the frameworks which are actually supporting these instruments are credible and well structured. So this is an important aspect of it. But the second, equally in my view, an important aspect is to structure the bonds that these are an affecting funding instruments. And I believe this is what we achieved when the Republic issued, first structured and then issued sustainability bonds. So this was very important. I have mentioned already that this the two bonds performed extremely well on the secondary market. That investors actually embraced these bonds. That the two bonds, when issued, were 10-year on-the-run bonds, being in focus for certain period of time until conventional on-the-run 10-year bonds were issued, and the very same approach we are to take when the Republic structured and when the Republic is to issue sustainability-linked bonds. So two very important aspects are key here to actually allow the bonds to be successful and accepted by the capital markets.
Yes, indeed, and I can only echo what you mentioned, that ambition, credibility, and transparency are key elements when issuing these types of instruments. And the role of SPOs is also very important, but most importantly, post-issuance, the verification of the KPIs as well. Now, as I mentioned in the introduction, the market of SLB saw a contraction last year, and there was some concern about the complexity of the SLBs. So I wanted to ask you really, when you've been discussing over the last weeks with investors, what is their feedback around that, and what's your view on the appetite of investors for SLBs nowadays?
Indeed, we started the discussion with investors on how they could potentially receive this kind of instrument. The feedback is very positive. But we still need to do more communication, I guess. We were conducting very successful communication with S&P, which was second-party opinion provider for the instrument. Need to say that very important thing is that the instrument is understood by capital markets. It is not too complex, but still credible. And in this context, we are currently envisaging to have one of the three KPIs on board for the first bond, which we are subject to market conditions about to issue. We also have, I would say, credible, in addition to have credible KPI, which is greenhouse gas emission reduction KPI, credible targets, where I believe it is very important that the probability distribution, that one of the two scenarios, which is coupon step up or coupon step down, happens is I would say uniformly distributed, so that there is equally likely that not meeting the targets, coupon step up can happen, or that is equally likely that if the Republic is outperforming the target, then there is coupon step down which follows. So I think the two things are of having more or less, in our view, similar probability. And in this context, I think the framework is credible.
It's a very interesting structure indeed that you are talking about, with a step-up coupon and a step-down as well. So it's a very interesting and innovative structure. And as you mentioned, I guess it's finding also the right balance between simplicity and the credibility also on the market when you talk to investors. That is important. So there's probably a lot of preparation, but then a good success probably. So if this SLB issuance that we look forward to is a success, which we hope for, what's next for you, Marjan, in the pipeline?
We are very much focused now to actually indeed issue the sustainability-linked bond of Slovenia. If we have successful bond issue, sustainability bond issue, we would definitely want to stay in this segment of the market, to actually start preparing for the new one, for preparing the following up, or the second sustainability-linked bond framework. But in addition to that, we definitely are determined to stay in the sustainability bond segment of the market, where we are start to prepare the third sustainability bond framework of Slovenia, where the objective is to further to improve the quality of the framework. And as a next step, we are actually determined to align the framework to do not significant harm criteria of EU taxonomy and to obtain second-party opinion for that. So to stay in this segment of the market and above all hoping that other sovereign issuers are to follow suit.
Yes, exactly. So we look forward to following your sustainability journey, and I personally look forward to reading your third framework, maybe opening the doors to a EU green bond in the future, if I understood well. Now, any other piece of advice you would offer to other countries that may want to follow the example of Slovenia?
We are doing this because we hope other sovereign issuers would actually also embark on this journey to show courage, to align green and social commitments of their countries to the financial actually commitments and to actually somehow work in the direction that the commitments, sustainability commitments they have in place and written in the national strategies and documents are having good chances to be met.
Well, I guess the advice I will remember is show courage, especially in these turbulent moments, Marjan. So thank you for highlighting that. On this, I would like to thank you and wish you all the best for the upcoming issuance and the many more issuances to come from Slovenia. Now, thank you for sharing your insights, and thank you to all of us, all of you who are watching online. And back to Judith.
Thank you very much.
Thank you, Leatitia, Hamon, and Marjan Divjak. Now, in our final conversation, we come back full circle to a topic Minister Roth mentioned at the top in his keynote speech, and that is about investing in the oceans. Now, the oceans provide not only the oxygen for every second breath we take, they're also crucial to the functioning of our global economic system. The value of goods and services from coastal and marine environments currently stands at an estimated $2.5 trillion per year. That's about 5% of global GDP, and that would make the oceans the 7th largest economy. In other words, the oceans are our natural capital, and the realization that this natural capital is at risk with serious implications for investor value led to the first Ocean Risk Summit back in 2018. Which in turn sparked the inception of ORA, the Ocean Risk and Resilience Alliance. Now, ORA's mission was to drive investment in ocean resilience, at least $500 billion by 2030, through a multi-sector collaboration that connects the private sector, governments, and civil society. Fast forward to this year, and ORA has become a pioneer and an enabler of an emerging asset class known as blue finance that helps to build a sustainable ocean economy. And our final guest for today is the co-founder and the executive director of ORA. She has a lifetime of working in leadership roles in this field under her belt for ocean conservation, for law and policy, and she has deep knowledge on the topic of sustainable finance. And she joins us literally from the seaside. Warm welcome, Karen. Again, I know you're joining us quite literally from Nice, from the United Nations Ocean Conference. So it's a specific treat and honor to have you with us.
Thank you so much. It is an absolute pleasure to be here. And yes, if I walked 10 steps, I would literally be in the sea. So it's warm and sunny here in Nice, and that may be something I need to do after we've spoken, Judith.
Fantastic. So it's a series of firsts that's happening there in Nice. You, I understand, are literally coming from the first ever Blue Economy and Finance Forum, which took place next door in Monaco. So what is your sense there as you were talking with Aura members, with investors, new and old? What is the momentum for Blue Finance?
So Judith, I'm usually, I call myself a cynical optimist. And oftentimes the cynicism wins out over the optimism. But I have to say that this weekend in Monaco, which brought together over 2,000 delegates from finance and insurance, asset managers, governments, civil society, other elements of the finance sector and the UN, I feel that we are on the verge of a turning point when it comes to the issue of financing the ocean. We saw 8.7 billion euros being committed to a regenerative and sustainable blue economy through to 2030, of which €1 billion has been committed to be deployed or invested in 2025. And while for some sectors that might not sound like very much, the ocean, which is, really it would be the 7th largest economy in the world if it was measured as an economy and would be sitting at the G7 table, it is woefully uninvested in. And yet without it, all of our lives are in peril. And so that health of the ocean and seeing the financial community step up and invest into it is really exciting. And I would just add that we also saw financial institutions with nearly $4 trillion worth of assets under management standing up together to give the ocean a seat at the table in their investment decisions and think about how through the work that they are doing and their investments, they are supporting a regenerative and sustainable blue economy. They are making sure not to invest into harmful activities. They are disclosing their activities and that they are learning more about the importance of the ocean and the climate and how the ocean's key role, both in terms of biodiversity and climate resilience, are absolutely critical.
Thank you for that. Let's briefly recapture what is the business case for investing in the sustainable blue economy as a high growth opportunity for those big players out there. Because I have a sense that there's the conversation shifting from merely doing conservation to making use of that high growth opportunity.
Well, I think the interesting thing here is that while most investors don't think about the ocean at all, without it, we don't have every second breath that we take. 80% of biodiversity on our planet lives in the ocean. 90% of world trade happens across the ocean, and it captures 1/3 of our CO2 emissions and 90% of the heat from those emissions. So if we put all of those pieces together and then add on top of that billions of people around the world earn their livelihoods from the ocean or rely on it for their primary source of animal protein, and that 40% of global populations live within 10 kilometers of the coast, that begins to paint a picture of how important it is. We did some work a couple of years ago with WWF and Metabolic, which found that over $15 trillion of assets are at risk over the next 15 years in just 6 sectors because of emerging ocean risk. So a warming ocean, an expanding ocean with sea level rise, acidification, which is harming coral reefs and other shell-like structures in the ocean, which are the natural coastal defenses that prevent storm surge from coming onto land, mangroves and sand dunes, which are also this kind of natural coastal infrastructure that protects all of us from storms, that is all degrading. And as that natural infrastructure degrades, as that marine life degrades in the ocean, its carbon carrying capacity reduces, our exposure and vulnerability increases. And so it is at our peril that we do not invest in the ocean.
And Karen, what certainly helps is that owing to growing investor interest, since 2022, the IFC and the Asian Development Bank, UN Global Compact and others, the ICMA as well, have published guidelines and practitioner guidelines on how to invest in a sustainable blue economy, in sustainable blue bonds that sort of have been up till now sitting under the roof of green investments instruments. And I note that last year the ADB listed, denominated in Swedish krona, 1 billion green bond focusing on the blue economy here in Luxembourg at the Luxembourg Stock Exchange, displayed on the Luxembourg Green Exchange. So can you share with us more how OR as a catalyst for blue finance has set in motion on the back of this push with more investor interest, specific initiatives with different partners? What should the market at this point know?
Yeah, so, I think what's really interesting is we set up ORA about 5 years ago, and it's quite unique. It's a multi-stakeholder alliance which brings together banks, insurers, multilaterals, governments, and civil society. And the idea is to break down the barriers, join the dots, and essentially connect from beachfront to boardroom all the different actors that are working in a regenerative and sustainable blue economy. Big investments are really key, but so are small. So we work at the beachfront with communities that have got brilliant entrepreneurs who are coming up with ideas to develop finance and insurance products that will keep those communities intact, more resilient, and able to finance themselves. And we connect those communities to financial institutions and governments because, of course, along with building the finance and insurance products, things like insurance for coral reefs or savings accounts for small-scale fishers, blue carbon products, biodiversity credits, we've also got to make sure that the governance and frameworks are in place so that there's greater certainty in those markets. And then we have to bridge the beachfront to the boardroom. And so we've worked with our members. It's an incredible collection and collective, really, of thinkers who've been able to put together the tools that are needed to bridge that missing middle gap, what we often call the valley of death, between those SMEs that are starting up, their grant and concessional funding to get to be investable and bankable opportunities for the private sector. So we've been working to set up an impact fund that invests into small island developing states. We heard this weekend that there are now 50 impact funds that are focused on the blue economy. They're not as big as some of the others that are in other sectors, but their focus is on this regenerative and sustainable element. And that means that sometimes the ticket sizes that they're investing in are smaller, but for small island developing states, which we call our large ocean states, these are countries that have small land real estate, but huge ocean real estate. They are actually hold 30% of the ocean under their jurisdiction. It's very, very difficult for them to get investment because of the smallness of some of the businesses, because of how spread out they are, and often because those businesses are in countries that have debt issues and credit rating issues. So we're setting up a fund that'll have a technical assistance facility to help some of those SMEs become investable propositions. And then we can join together with some blended finance vehicles to invest in them. We also know that we've got to drive local currencies into some of these economies and de-risk some of the investment landscape. And so we are developing Nautilus, a blue guarantee company, to help encourage local banks to invest into local small and medium-sized enterprises. They can also backstop through guarantees some of the bigger instruments like debt for nature conversions, as well as blue bonds. And then we are developing what we call our Octopus platform, which is a matchmaking platform between some of those SMEs and the investors that are looking for those opportunities. In addition to matchmaking, it's also going to be a knowledge sharing platform powered by Agentforce, agentic AI from Salesforce, that can really help in a very quick way to link these different actors together, but also to help them to present themselves as investable opportunities. And then finally, we are working with partners on building a blue bond accelerator. Judith, you mentioned blue bonds earlier. We did some research last year where we found that there's about $550 billion worth of investment per annum into this regenerative and sustainable blue economy sector. And yet only about 10 billion has been invested over the last several years. The opportunity to 2030 is for $70 billion of blue bonds to be deployed. We know that's only 7% of the green bond market, but that could exponentially shift what's happening in this marketplace. And all those bonds, of course, need those projects to invest into. So building the systemic, high-functioning ecosystem that can feed on itself to propel the work forward.
Well, I have no doubt, Karen, listening to you, that all this innovation and effort that you and your team and your collaborators are pouring into the space will carry rich harvest. But one question that remains with me is the liquidity that we see with big institutional investors and those private equity players. What's still missing to bring them into the boat, as it were?
That is our big challenge right now. Some of the deals are not big enough. Some of the markets that that need to be invested into are seen as risky. And this is where we need governments and the public sector to step in. Actually, yesterday, I was at an event where the public development banks have joined together, 20 public development banks, to focus on an ocean investment coalition, so that they can stand behind some of the institutional investors to backstop and assist with that liquidity. We use a lot of ocean analogies in our space. So for us, this is really an all hands on deck moment. The biggest peril is not acting. We still have 5 years that we can make a difference in. The science is so clear. We need to be patient with capital, but impatient with our action and investment. And that takes all of these different actors working together to move the needle significantly.
And create, I suppose, those bankable products that are then attractive to big investors.
Absolutely. And, we've seen in the past 4 years or so, we make grants to help develop that pipeline and link them in with our partners. We have now 50 projects in our pipeline, 30 of which are developing finance and insurance products. And we anticipate that 12 will have gone to market by the end of this year already. So we're seeing the finance sector step up. Our lead global insurance partner is AXA. Our lead global banking partner is Deutsche Bank. This weekend, we were with BNP Paribas, Mirova, Eurazeo, Deutsche, Standard Chartered, all working together on how we can activate this finance. And I think what's key is this mix of investable opportunities, the basket of available and transformative activities that can match each investor's need. So where some investors may be looking for financial returns alone, offshore wind, marine-based renewables, and then, of course, port and shipping infrastructure, shifting through the transition to green energy and transitional fuels, where there are clear bankable returns, to looking at those investments that have less in terms of the financial returns, but much stronger social and environmental returns to, of course, investing in ocean conservation and the whole ecosystem that feeds off those. All of these things play an integral role and offer opportunities for investors across the capital stack.
We should also look at the other side of the medal. In April, of course, at the meeting of the International Maritime Organization, a majority of countries agreed to a compromise that all ships must pay for the CO2 that they emit from, I understand, 2028 onwards. This links back to what you said earlier about avoiding harmful activities or making sure that emissions are reduced as well. So give us an idea why this agreement is so important in the context of your innovation around a sustainable blue economy.
The IMO agreement is really important in that it's the first agreement in an ocean sector to recognize that together, working in alignment, the sector needs to help finance its transition. And in our space, in addition to investing in a nature and climate positive manner, we also need to see investors withdrawing from the investments that they have made in ocean harmful activities. And there is, all the facts about the impacts of shipping in terms of its CO2 footprint, in addition to shipping impacting the ocean in terms of ocean noise. Your listeners may not have thought about this, but if you think about swimming in the sea or in a swimming pool and how noise changes and carries and distorts, the noise of all of these engines around the world is really harming marine life. And so thinking about transitioning to quieter fuels, slow shipping, reducing the speed of ships, which reduces fuel emissions and also avoids ship strikes. These are some of the things that the industry is recognizing needs to begin to happen. There's still a long way for them to go, but that's also being picked up by the insurance sector and by the financial sector as they look at the future, the 5 to 10 to 15-year future of the shipping sector and how it becomes future-proofed and transitions to a net zero economic paradigm.
And we should, in that context, also mention the problem with deep sea mining. I suppose this is a no-go for AURA members.
Absolutely. If you want to join AURA, we'll talk about a lot of things. But from our perspective, seabed mining is something that is on the no-go list. There's an absolute red line. We know so much about how the ocean captures carbon, but we know so little about how much the deep seabed does, although we've recently learned that in addition to capturing CO2, it also produces some of the oxygen that we breathe and is full of marine life. Every time anyone goes down there, we discover more about the deep sea and more about the species that are down there. And so until we know more, what we should be investing in is a circular economy in terms of some of the rare earth metals that we need to look at, and understanding how we can repurpose those metals rather than destroy ecosystems that could save our lives in the future. As I think President Macron has said here this week, we need to focus on Neptune, not Mars. Neptune for us is the ocean, and it is the planetary system that has been sustaining us. We can't risk our future anymore. Truly, our biggest peril is the loss of marine life in the ocean, and that is not a risk we can afford to take right now.
Thank you so much, Karen. A final word for those investors out there listening. Can they reach out to you? What would you like them to hear as a final word?
Absolutely. The Ocean Risk Alliance, you can find us at oceanriskalliance.org. Please reach out. We are welcoming of financial institutions who are keen to move forward on their blue journey. And we've actually just released with Builders Vision, Ocean Catapult and the World Economic Forum, a document which provides 42 investable opportunities that can help transform the ocean. So take a look at that, visit our website, there are contact details on there, and we would very much like to work with you and see how we can drive ocean investment for the future of our planet, for people, and for the investment community, and where it is looking to ensure that shareholders, stockholders, family offices have those investments secure for the next 20 to 50 years.
Thank you so much, Karen Seck there.
Thank you.
And that wraps the Sustainable Finance Forum 2025. A heartfelt thank you goes out to all our expert speakers. We hope that you find their insights useful. And I encourage you to go back and listen to the recording. The email with the link should be in your inbox very soon. And a shout out also goes out to the team at New Financial. Again, the report is free for you to read right here on the website of Luxembourg for Finance and has a lot more details than William Wright was able to cover in a few 20 minutes. Our gratitude, of course, also goes out to our sponsors and our media partner, the Financial Times, and to the production team behind the scenes here in the studio. And, of course, to you, our audience from around the world, for listening and watching and for engaging with sustainable finance. We will, of course, continue the conversation on sustainable finance because, as Minister Roth said in his keynote, the aim is to make sustainable finance the new normal. Made in Europe, he said. We see ESG not as a trend, but as a strategic and moral imperative. On that note, take good care and see you next time. Thank you.